Hello and welcome to this brand new edition of Commodity Talk. This is Shivendra Kumar from ET Markets team. We are in the final leg of 2025, a year that has turned out to be momentous for metals. Precious metals like silver and platinum have already delivered multi-bagger returns, while gold an impressive 80% so far. The anticipation for 2026 is already building, and we want to know what the outlook is for gold, silver, and other metals in the new year. I have with me Mr. Anindya Banerjee, Head of Commodity and Currency at Kotak Securities, and he will give us the outlook for next year and his valuable investment tips. Hello, Mr. Banerjee. Great to have you with us. How are you doing?
Namaskar and thank you for having me.
Hi.
I'm doing excellent.
Good, sir. So, without wasting any time, let us start. Uh, when 2025 was about to begin, there was an overwhelming view that gold at best will be able to hit targets of 85 to 90,000, while silver around 1.1 to 1.2 lakhs. But at the end of 2025, are you surprised with the kind of rally that we have seen for the full year, sir?
Right, it's a very interesting question. See, last year we had a kind of a contrarian view in the sense that we were very much focused on the underlying fundamentals which could drive metals, specifically gold and silver. So that's why, as the year progressed, every month we kept on talking about a bullish view. Initially, it looked like too far fetched. I'll explain why we were so convinced that this whole structural move in gold and silver could play out. Because we were basically focusing on two major fundamentals. One was the de-dollarization, which is basically means that end of dollar as a reserve currency status, and that has been playing out for some time now. Last 5 years, 4 or 5 years, it has accelerated as central banks have, I would say, diversified from their dollar assets towards gold. That's typically what happens with gold historically. As far as silver is concerned, of course, the de-dollarization was the play. Apart from that, we were very much focused on the uh, building up shortage in the market, because it's been like last 5 years, this market has been seeing a less of supply compared
Shortage.
to demand. So combination of two made us convinced that we could see a quite a big move in gold and silver.
Okay. So, do you think this kind of a rally, this exuberance, will last in the next year also, or for that matter, in the foreseeable future? Because, like I said, too much money is now running on gold and silver. So, at this price point, do you think the levels are justified from the perspective of a retail investor?
Hello.
Yeah. Am I audible? Hello, Mr. Banerjee. Hello. I think there's some problem with the network. We'll probably try to get that back.
Hello.
Mr. Banerjee, your frame has frozen. I can hear you.
Yeah, yeah.
I can hear you.
Is it fine now? Is it fine
Your
now?
your voice is audible, but your frame is still frozen. Okay, if you can hear me, let us.
Just a moment. Yeah, I'll just a moment. Is it working now? I'll just
Your
switch
frame
the
is.
hotspot. I'll switch the hotspot. Just a moment. Uh, Connection connect device. Let me. Yeah, is it fine now?
Yeah, it is fine. Yeah.
Yeah.
So I was saying that given the kind of rally that we've seen this year, do you expect something similar in 2026 also, or for that matter in the foreseeable future? Because too much money is currently chasing gold and silver, and at these levels, do you think the price point is justified for retail investors?
Right. Because that is a question which is, I would say, top of the mind across all investors. See, the correction will happen. We have seen a correction in gold and silver in October. There was a sort of euphoria. Gold fell around 10-12%. Silver fell around 20-25% in 3-4 weeks. And then since then, we have rallied. It went to 1.7 lakhs on MCX, came down to 1.4, and now it is around close to 2.4. So the point is these kind of corrections will happen along the way. I'll come to that. But the overall structural story is intact because the de-dollarization and the shortage. So de-dollarization and shortage is not a 1 year kind of a phenomena. So we expect, if we take gold as an example, what is happening? The central bank buying may slow down because they have a certain portfolio, or you can say their reserve allocation in mind. But we are seeing a lot of interest from institutions, and especially the Western institutions. They are highly underweight on gold. And now we are seeing talk of 10%, 15%. Some are even saying 20%. That's also happening across Asian institutions and Indian institutions, family offices, other kind of funds. So that kind of allocation can rise. And at the same time, we are quite bearish on dollar, which means that the dollar debasement rate can accelerate, and gold is perfectly positioned to capture that. Gold. So we are quite bullish. We expect gold to even go as high as $5,500. And
I think
is
there's
it fine
some
now?
problem.
Are you able to see me?
Yeah, I think we
Hello?
missed the last part. Yeah, I can hear you, Mr. Banerjee. Am I audible?
Hello?
Mr. Banerjee, you are audible.
Hello?
Mr. Banerjee, you are audible. I can hear you.
See me?
Yeah, your frame has again frozen.
Can you see me?
Your
Actually,
frame has
what happens is
frozen.
that basically we just had a power. So actually, I had to switch to from Wi-Fi to mobile. Any call comes on my mobile, it disconnect. Just a moment.
Yeah, so I was asking that
Yeah.
where,
Sorry.
as an analyst, where do you draw the line given the current levels?
So as I was saying, like the top of the mind question right now with investors, that is this the end of it, or is there a steam left? We think it's a structural story of 5 to 6 years or more, because what is happening, the de-dollarization which we are seeing, where we are seeing the central banks move away from the concentration in dollar towards gold. That's not going to end because they have a certain allocation in mind of their reserves, which they are going to do. And we are seeing a lot of demand, not only through official channels, but also from unofficial channels, especially from the Chinese central bank. But what's interesting, that data that is known to everybody. But what's interesting is the demand for diversification from institutional investors. I'm talking about the private funds. So be it Western funds, Asian, they feel that they are extremely underweight on gold and especially silver. So now they are thinking in terms of allocation. Some saying 10%, some 15, some 20. That
Okay.
kind of can continue to come and be quite supportive of this structural bull run in gold. So this can take gold, in our opinion, towards $5,600, $5,700, which is around 25 to 30% from this levels. And we are also quite bearish on the dollar, considering their economic fundamentals and the whole pressure on Fed to cut rates, to do QE. They've already launched a QE of 40 billion. So in spite of the fact that the inflation is high in America, because Trump is facing an election risk next November, the midterm polls. So we expect the dollar debasement rate to pick up speed, which will be quite beneficial to gold and silver and other metals for bullion. Now, coming to silver, the structural shortage story is not going away, because no new mines are expected to come online, and 70% of the silver supply comes from other metals, gold, copper, other things. So unless those mining activity is picking up, and that doesn't pick up in 3-4 years, it takes longer cycle. So the industries which are catering, the photovoltaics, the electronics, the electrical, the green energy, and other things, these are sectors which are expected to grow in the coming years, not something which is just going to be displaced the demand. So overall, we are quite bullish on gold and silver. The volatility in silver could be much, much higher. That's what we have to understand, because right now what is happening is there is a huge demand supply squeeze which is underway. India, China, Russian buyers are basically taking physical delivery of the metal, and the supply from the Western institutions like CME or LBMA is not able to meet that demand. And we are seeing the kind of premiums which are there in silver in Asia. For example, on Shanghai, the current silver prices are quoting a premium of around $6 to $7 over COMEX. That doesn't happen in normal market condition, because simply you can do an arbitrage. You will sell on Shanghai, buy on COMEX, and ship the metal. But that's not happening, because standard premiums are $1 to $2. It has blown up and sustaining there. So these are indications of a developing physical market squeeze, and that can accentuate the move. We won't be surprised if silver goes to $100 plus in 2026. And which means on the MCX, it could get very close to the 2.8 lakh mark, depending on where the USD/INR is. So yes, so this is a structural story, but one should invest on dips. Utilize the dips like we got in October. We'll get those dips along the way of 15-20% in silver, of 10-11% in gold.
So at this point in time, you would suggest that if prices are rising, it is better to be away, wait for 15-20% dips, and then make a move. I mean, this FOMO thing is something which is actually getting onto the people. And every time, because the prices have not been sustainably coming down. So there is a feeling that, what, if I don't buy at this level, it will not, because the level of 1 lakh would never come again, even if 15-20% correction comes. So that FOMO thing is something, which is actually a bigger trouble. In light of that, what will be your suggestion to investors and traders in terms of strategy in gold and silver, and also the allocation that they should probably go with? Retail investors.
Absolutely. In fact, I would say we should focus on portfolio allocation, because that really wins over the long run, rather than focusing on invested a lakh or 20 lakh on a particular thing, how much it has done, because it's not possible for a retail investor to handle this kind of volatility. And in our opinion, the volatility the next 2-3 years will be phenomenal, up and down both. Now, how the strategy? The strategy would be a combination of lump sum and SIP. What do I mean by that? One can start a SIP, because just to beat the FOMO factor, if I just wait for the correction, because we have actually seen live examples of it around October. A lot of people were waiting for the correction to play out from the October start, and it was not happening. The prices would keep on going. It crossed a lakh, 1 lakh 10, 20. And finally, they all entered around 1 lakh 50, 1 lakh 60, 1 lakh 70, especially around 1 lakh 70. And what happened when that fall came from 170 to 140 or lower? A lot of them got flushed out, because they got they all panicked. So the better ways to handle the FOMO risk is to basically create a SIP. So SIP will do the time averaging. Once that correction comes, you do a lump sum, because that is a good way to take advantage of
Okay.
both. So that applies for both gold as well as silver, especially for silver. For gold, we don't have that kind of volatility. A 5-10% volatility is manageable. Sometimes in silver, a 20% can become even a 30%. If, let's say, we have a stock market crash globally, then due to margin calls, such things can become accentuated. So this strategy can work well. Now, coming to the portfolio allocation, generally it is recommended 15 to 20% of your financial portfolio can be in gold and silver, because it has delivered a risk-adjusted return not just for 1-2 years, for 25, 30 years. So it is a very important stability anchor for a portfolio.
Okay. I mean, very useful tips. A mix of lump sum and SIP. Yeah. So yeah, I mean, this is something which is the right way to go ahead. Another metal which has made a lot of headline is copper. Probably 40% or more returns, and this is its best returns in the last 5 years. So just wanted to understand what is the outlook for copper in 2026, and like it is being dubbed as a next gold. I mean, we hear a lot of analysts saying, calling it a next gold. Do you really see it as a substitute for gold and silver?
No, in fact, copper is a pure industrial metal. Gold is pure money. Gold has not much of industrial use that we can really talk about. It's pure money. Just imagine a fiat currency and gold, which is metallic money, which has been there since eternity. Now, comparing with silver, yes, we find some connection between copper
Industrial.
and silver. And they also belong to similar industries, because they have that conductivity principle, which is they are good conductivity of either heat or electricity, some kind of energy.
Yeah, renewable.
So
They have a lot of value in
renewables.
yeah.
So I would say one should play copper as an industrial theme. And as I said at the start, what is happening now is that, which I talked about gold and silver, is that because of de-dollarization, there is a move away from fiat currency towards hard assets. Now, that hard assets could mean platinum, could mean copper, could mean zinc, could mean aluminium, could mean any metal, but only those metals which have a structural deficit story, like silver, like platinum, like copper, they are doing exceptionally well. And copper has got that fundamentals, which it makes it a compelling story for the next 3 to 4 years, because there are no new mine supplies in a big way which we expect to come over the next 24 to 36 months. The current mine supplies are disrupted, like the Gasberg mine in Indonesia. Now, demand is rising significantly, because it's
Picking up. Yeah.
coming up again from those new industries, green energy, right? So that, and plus, when I look at the contribution of the cost of copper to the end product, it's not significant as of now, but the kind of electrification that is planned across the globe because of the AI and data centers, the demand for copper will also rise. So yes,
Right.
copper is a industrial play, and but where is the risk? The risk is if we have a recession. If we have a recession in US, or if we have a dramatic slowdown in China, it will
China.
hit copper. If we have a stock market crash, it will hit copper. Like, for example, in April of this year, when Trump announced the reciprocal tariffs and the stock market crashed, copper prices also crashed. So again, now the strategy around copper has to be very different from gold and silver, because it cannot just be a part of the long-term portfolio of somebody. So one should be looking at those dips, those pullbacks, to actually build a position rather than buying at any price. Currently, the prices have run up considerably. For example, today it's up 8.5%. That's not the time when one should be buying copper. It's around 1270 on the MCX, around 12,000 plus on the LME. So we expect it to head towards 14,000 levels on the LME and around 1400 on the MCX. But it's better to wait now. This is not the time. Around, let's say, below 1200 or close to 1150 is a good opportunity to buy copper.
It remains a tactical trade.
Yes,
You have
it's a
to
time.
just okay. And what about other base metals? Any
So if I keep copper as number one, I will keep aluminium as number two. Again, there is a tight market which we expect it to develop in 2026. Not as tight as copper, but that can push aluminum prices another 15-20% higher from the current levels, which is close to 300 levels on the MCX, around 290 odd. So we could see the aluminum prices rise another 15-20%. But again, this is a tactical trade. This is not something I can buy at any price or do a SIP and forget it. Zinc is also looks good, but not as compelling as I would say aluminum. Nickel can be a contrarian trade. It has been consolidating for a long time, and we could see a 15-20% jump in 2026 if this dollar debasement trades gains hold. And lead looks to be quite market.
Okay. Rupee always remains an important factor as far as commodities is concerned. We have seen a falling rupee, probably 5% down this year, and which has supported metals for that matter. So, what is the outlook for rupee? We have seen the Central India RBI's stance that they are not targeting a specific level for rupee, but if rupee continues to slide, this will always be an added benefit for metals, especially gold and silver. So, how do you see this rupee factor play out?
Right. The Indian rupee is added around 5-6% to the overall price jump. 2026, we are taking a little contrarian view. The first quarter, we could see this upward momentum in the USD/INR continue because of the outflows, FP outflows, and also because of the uncertainty over the trade deal with the US. But what's happening in the background, if somebody takes a medium to long-term view, is that if you look at the Indian story, the economic story, it's very compelling. We have high real growth, structurally low inflation. A path to reform has been consistent and clear, with no macroeconomic risk. So, and plus at the same time, 2025 is an interesting year. There's been hardly a very few currencies which has depreciated against the dollar. In fact, we can count on our fingers. And out of those currencies, Indian rupee has been one of the weakest. Now, with a very compelling fundamentals. Now, at a time when dollar index is down close to 10%. Now, what did this happen last? It happened last in 2013, when we had fundamentals which is just opposite. So now that means Indian rupee is looking quite cheap and undervalued. And at the same time, when I look at the US prospects, as I said when I was talking about the precious metals, the US macroeconomic condition is not looking good because their consumer economy is sinking. We are looking at various indicators, the job prospects, the real wage growth, the underlying high cost of living, the delinquencies beyond auto loans, beyond student loans, everything. So that is creating a K-shaped recovery in America, and that's making the policymakers very concerned. And that's the reason why what we can see more from Trump and his administration is he's openly talking about more fiscal spending, more freebies, because he has to win the election. And he wants Fed to backstop it by buying the bonds, by cutting rates aggressively because the yields are rising, right? So that is a classic case where you have a pressure on the currency because as a central bank, you cannot control bond yields and currency and inflation all together. You have to at least let go of one. And in this case, it will be the currency. So that's why on one hand, rupee looks undervalued with compelling fundamentals. On the other hand, we have an economy which is looking quite challenged and with rising various kinds of risk, be it political, be it policy, be it macroeconomic. So when I combine these two, it makes me quite bullish on the rupee. First quarter, we could see 91. It could overshoot to 92 if the outflows accelerate from emerging markets and India. But by December of next year, we expect it to appreciate and come back towards the levels of 85, 86. So we expect a good closing for the rupee next year.
Okay. And finally, just a short comment on oil. Because I think this will be the fifth consecutive year of decline. I'm not sure.
Right.
But but it has been downhill for crude oil. I mean, it is good for the inflation situation, but what happens to the traders or investors who are in the business?
Yes, in fact, it's good news for us because we are a major consumer of oil, and the oil prices are not very far from where they were in 2021. See, the overall the supply demand fundamentals are bearish on oil. Now, what can work in favor of the oil in short term are the geopolitical risk, be it Iran, Israel, be it Ukraine, Russia, or be it America, Venezuela. So these can
Hmm.
from time to time support oil prices, but for next year, and one more factor which could support oil prices is that generally what happens when you have a weak dollar or a dollar debasement rate, finally some money moves to energy, because energy has been a big laggard compared to energy, and agri has been a big laggard compared to metals. And generally what we see in commodity cycles is that first to move are metal, second energy, and along with agri. So it might so happen some money may get allocated next year towards energy, which could support the oil prices. But overall, we expect a very range bound kind of a situation. $50 on the down, on the Brent, on the WTI, I'm saying, and on the up around $70 if some geopolitical risk materialize.
Okay. Thank you so much, Mr. Banerjee. It was a pleasure talking to you and a lot of
Now is
insights
not
for our.
right, because we have a non-OPEC supply, which is expected to more than meet the total global demand growth for 2026. So that's not a very hello.
Yeah, I can hear you. Please go on.
Yeah. So that's not a very bullish thing for the oil market. So we expect a very range bound kind of a situation in oil.
Okay. Thank you so much, Mr. Banerjee. It was pleasure talking to you and a lot of insights from your side to our viewers. And
Thank you so much.
my best wishes to you for the next year, irrespective of where gold or silver is.
I wish you the same.
Thank you, sir. Thank you so much.
Thank you. Should I disconnect? Yeah. Okay.